Good day, everyone. You are welcome to this week's Business and Investment Tips program, a production of Christ Church Radio. My name is Ayodeji Ebo, an investment professional. This week, the focus is on IMF's SDR allocation to Nigeria and implications for the economy. The Board of the Governors of the International Monetary Fund, IMF, approved a general allocation of special drawing rights (SDRs) equivalent to $650 billion on the 2nd of August 2021, the highest in the history of IMF. The SDR will be a shot in the arm for member countries still trying to recover from the COVID-19 pandemic. The SDR allocation became effective on the 23rd of August 2021, implying that funds have been disbursed to member countries. Based on the IMF quota, Nigeria received $3.35 billion of the SDR issuance of $650 billion to boost the FX liquidity of member countries. This is about 10% of Nigeria's foreign reserves, which stood at $33.4 billion as at 23rd August 2021. What are SDRs? SDRs are interest-bearing assets maintained by the IMF as a supplementary reserve for member countries. Although SDRs are not considered to be money per se, the value of SDRs are based on 5 of the world's leading currencies: the US dollar, euro, the UK pound, Chinese yuan, and the Japanese yen. SDRs are used to augment a country's foreign reserves in order to ensure that there is supply of foreign currencies, which are key to international trade, e.g. imports of medical supplies or vaccines during a pandemic. Members of the IMF can trade their SDRs for currencies of other member countries, or even use it to settle existing debt obligations at the IMF. More importantly, SDRs allocation are cost-free and do not add to a country's debt if retained in the external reserves. However, any amount spent from the SDRs will be classified as debt to the country, but come at a very considerable floating rate at 0.05% as at July 2021 and flexible repayments. Implications for Nigeria. Overall, the SDR allocation will have a positive impact on the economy. However, it is inadequate in fixing Nigeria's FX liquidity challenges unless exports recover strongly. The direct impact of the SDR allocation are highlighted below. 1. Increase in Nigeria's foreign reserves. Nigeria's foreign reserves was $34 billion as at 2nd September 2021. Foreign reserves or external reserves are assets held by the CBN in foreign currencies, which includes foreign banknotes, deposits, bonds, treasury bills, and other foreign government securities. Some of the objectives of external reserves include: A. Provides a level of confidence to the market that Nigeria can meet its external obligations. B. Helps the government to meet its foreign exchange needs and external borrowings obligations. 2. More resources to defend the naira. With expected improvement in the foreign reserves, the CBN will be able to increase FX supply, which will prevent the further depreciation of the naira or perhaps drive an appreciation. 3. Boost confidence of foreign investors. Due to the reduced inflow of FX, the CBN reduced supply to the foreign investors trying to take out their funds from the country. This created backlogs of demand. On the back of the SDR, the CBN may clear or reduce the backlogs. However, this may not immediately translate into improved foreign inflow of FX. Additionally, the federal government is expected to issue Eurobond of about $3 billion, which would provide further support to the external reserves. This will have similar positive impacts as the SDR. If effectively utilized, we should see an appreciation in the naira in the parallel market. Thank you for listening. Please join us same time next week for another exciting and interesting session. For comments and feedback, kindly forward to ccradio@rccgchristchurch.org or send SMS to 07082463747. Stay blessed.